Good afternoon, and welcome this afternoon to Trading Growth and Value Stocks. There's the bell, and thankfully for some people, perhaps after a pretty wild afternoon following the FOMC announcement. Hey, I am joined out there in the chat today by my good friend Cameron May, who's a phenomenal educator and a 20-plus year veteran of the financial market. He's there specifically to answer your questions. I'm here filling in for James Boyd today, and we're going to talk a little bit about trading growth and value stocks, and it's been an interesting day for sure. So we're going to talk about that as a context for this idea of looking at growth versus perhaps value versus income and dividends. And we're going to kind of bring all of that discussion into the mix here. And as we do that, a couple of quick housekeeping items, though. First, remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security, pattern, strategy, idea. Remember that technical analysis is only one way to look at the market. Fundamental analysis is another. Probability analysis, a third. Those are all theoretical in nature. None of them guarantee how the market is going to perform or how our assessment of the market might be. Because of that, Schwab doesn't recommend use technical analysis or any other individual means of research as a sole means of investment research. Now, we're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version. That's a great sandbox to learn in. Doesn't translate into success in the real world, so make sure that you're aware of that. Also, there are risks associated with investing in stocks in general, but also in dividend-paying stocks. Dividends can change. They are subject to changes in the part of the company. They can decide to not pay dividends. They can decide to change those dividends over time. So those aren't guaranteed. Also remember that past performance, no guarantee of future results. So let's jump into this discussion just with a quick discussion of the thought process behind this. And again, like I said, I'm filling in for James. James, I know, has a particular methodology. Our methodology in this approach is likely to be different. And not because one is better or worse, but simply because he has a different perspective than I do, and I have a different perspective than he does. Cameron has a third different perspective. But thanks to all of you for joining us and bringing your perspective to this discussion today. So we're going to talk a little bit about this idea of growth and value. We're going to talk about the criteria that we might look at, and then we're going to look at some examples on the platform. And I think this is a great opportunity to do that because it's very likely that we're going to have some stocks that have maybe changed their perspective, changed our view of them in the last day. Now, we'll see if that means that that's going to be a permanent change. We don't know. Or if that's going to be an overreaction. We don't know that either. And so we're going to jump into this discussion with the idea that primarily around growth investing, focusing on capital appreciation and less importantly on intrinsic value or valuation. And I'm going to amend that a little bit. We're going to include dividends into this discussion. So we're going to call this growth and dividend investing. So we're going to jump into this discussion. I'm going to pop over here to the thinkorswim desktop platform. We'll close down the left-hand side, take a look at what's going on in the market as a whole, at least across the broad indices. I was on earlier this morning, and some of you were with me talking about protective strategies. And, you know, if there were ever a day where, you know, at least maybe some short-term protective strategies might be a strategy to consider, today might be one of those, as we had the FOMC coming out. And the kind of out-of-the-box news was a 25 basis point cut. That was expected, right? The question is, because a lot of this movement happened, if we take a look here in this breakdown below the 50-period moving average on the SPX, we were talking about this morning as kind of holding that level. We saw that the RSI was kind of sitting there. Now we see that the RSI is making a lower low, right? Now, the question is, does this change, right? I mean, is this a trend change? Depends on how you look at it, right? Because, yeah, it's below the 50-period moving average, but it's not a new lower low necessarily. It's an equal low. It's not a new lower low in the context of the longer-term trend. That would put us well down here. It's not anywhere approaching the 200-period moving average, which is the longer-term moving average. It's simply a reactive push to the downside. Now, the question becomes, does that continue? Let's take a look at the other segments of the market, the other indices. Take a look at the NASDAQ. And the technology-heavy NASDAQ, not even getting down to the 50-period moving average. It's not touching that, not making a new low in that context, still moving higher. The Russell 2000, on the other hand, the one that we would expect to perhaps have the biggest influence and the biggest impact from interest rate changes, and theoretically would benefit from a reduction in interest rates, is the one that actually took the biggest hit. Now, the other side of that coin is we see a push down below the 50. We see a break of a horizontal support, which is also a consistent or concurrent low. And so we see a new lower low relative to this kind of intermediate time frame. We see a test back down here around a horizontal support around the 2206 mark. But we also see the RSI kind of shaking itself out all the way back down into this kind of lower, if you want to think about it, lower reversal zone, right? I don't think about it from that standpoint of being overbought and oversold. Those tend to be more pejorative terms, and it says that if it's sold down to that level, it can't be sold more, and it still could. Or if it's up and overbought, that it can't be bought more, and nobody's buying it because it's up in that overbought. Well, it sure can, right? So the question might be, is this a reaction, right? Is this a reactive scenario here? Or an overreaction, maybe. So what I wanted to do is I wanted to shorten up this time frame a little bit and take a look at across these charts a little bit. Let's take a look at a 5-day, 5-minute chart, just simply from the standpoint of what went on. So we had kind of overall movement, and we saw the push to the downside on the announcement. That came right about noon, right? And then we saw that push down lower, as we saw the numbers come off. And then now we're here at about the beginning. This is the beginning of the news conference on the part of Jerome Powell, right at that horizontal support. This is the Russell 2000. From that point, that's where the majority of the damage happened, right, was to the downside. So that tells me that it wasn't necessarily in the initial 25 basis point cut news, kind of the headline, right? That maybe it was it was some of the things that Jerome Powell was saying in the news conference that caused the market to kind of make this move to the downside. Now we're starting to see a little bit of a lift, right? Coming back up off of that low. If we were to take a look at the S&P 500 in that same time frame, the 5-day, 5-minute time frame, you can see the same kind of things happening here. So here's the move. Here's the wait to see before the press conference launches at 1:30 in this case. And then, boom, we see that move to the downside. Now we start to see maybe a little buying stepping back in towards the end of the market, right? So we see a little bit of a shift here on the short-term basis. But short-term momentum, as far as the RSI is concerned, starting to kick back to the upside. Speaking of kicking back to the upside, I noticed we have a feedback survey there in the chat. Cameron has kicked that up to the top of the webcast, or the chat feed there, and that's going to be available. He's pinned that up to the top of the chat so that you can see it, and it's easy to find. So do me a favor, open that up, fill it out, or open it up, set it aside. Either way, open it up so that it's ready to go, so that you can fill that out, because that helps us make these sessions better. We certainly appreciate you doing that. The other thing we appreciate you doing is clicking on the subscribe button down here at the bottom of the page. It's that little YouTube logo there. And that's going to keep you updated as far as, new content, new postings of archives, things like that. More importantly, it's going to, I think, help you to stay in contact with, make it easier to find the content here on the Trader Talks webcast YouTube channel. And it's at no cost to you, so we'd appreciate you if you would click on that subscribe button. So now what this suggests to me is that maybe tomorrow, as we get into the end of this week and we get ahead of the holiday shortened week, that there's a very real possibility that traders who have been, if we go back out to that time frame, now back out to a 1-year daily chart here, traders who have been significantly buying these dips, right, off these downside pushes from a growth perspective, from a price appreciation perspective, right, have been stepping in at these levels. And they've done it once, they've done it twice, they've done it 3 times, 4 times, 5 times, 6 times, maybe. So the question is something different now? And maybe the something that's different is that the RSI is pushing a little bit lower, but that might be reactive simply to the breadth of this particular candle. This is the largest big down candle that we've seen perhaps all year in the SPX. And maybe that's because it's at the end of the year. Maybe that's because, and again, I didn't hear, I was doing the network charts behind the scenes during the press conference. And so I was only kind of hearing it because I was also hearing the producers. So I didn't hear all of the context. Regardless, knowing that news conference was out there and was going on concurrent to this, whatever the reason is, and I don't know. I mean, we can speculate on what words it was that Jerome Powell said that triggered the market to make that move to the downside. The question becomes, what does it do tomorrow, right? What does this market do in response to this? And we can't know, right? We just can't predict. Technical analysis doesn't let us predict. Fundamental analysis, not likely to change until we get to the next earnings announcements. Fundamental analysis in general isn't going to predict what's going to happen to price appreciation. So we kind of have to stick to those scenarios, right? And Ricebird, I think that's a good point, right? Cautiously invested, lots of stops triggered, lots of protective strategies came into play. And I think a lot of this downside move is, in fact, exactly what you are and many others are suggesting. This was the triggering of a lot of stops that had been tightened up. I mean, we even talked about it earlier this morning in the Protective Strategies webcast of bumping up protection in the form of, say, something like a protective put, where that strike price got a little bit tighter against some of those positions. And so seeing something similar, many of these stops perhaps getting triggered out and kicking to the downside. That would suggest that caution abounds, right? And theoretically, that's the case. Let's take a look at what happened with the VIX, because I'm interested. The VIX was actually down a little bit earlier this morning as we went in this, but we see this big volatility spike. And we had talked about this, right? We had talked about the fact that the last couple of times we had those press conferences, the last couple of times we had FOMC meetings, we had a moderate rise in volatility that bled off pretty quickly. This was a pretty solid move to the upside in terms of volatility. It was a solid move to the upside in terms of volatility. It was a solid move to the upside in terms of volatility of volatility. The VVIX making this move, just alongside the VIX. Now, the VIX moved more than the volatility of the VIX, but that typically does tend to lag just a little bit in big moves like this. But that also suggests that if volatility didn't expand beyond that range, or the volatility of volatility didn't expand beyond the VIX, that this is likely to be short-lived, right? And I hate having to replace leaky water heaters. Yeah, absolutely, Ricebird, I get it. But in this scenario, right, I mean, we could see this bleed off very, very quickly. But that suggests, this volatility move suggests that this is, again, kind of a upset to the apple cart, maybe a bit of a panic type of move, and maybe not a change necessarily overall volatility. If we see volatility stay elevated over the next few days and into the end of the year, that maybe becomes a concern over the course of the next quarter or so, into the next over the horizon. We're on the cusp now. I mean, we're just a few weeks away from really kind of kicking back into the next earnings season, which is going to impact fundamentals. So now here's kind of the backdrop, right, of what's been going on. So what I wanted to look at really quickly is I've got another grid, and this kind of goes back to this idea of growth investing. and the idea of where do we find some of these stocks that maybe are still seeing price appreciation? Because even if an abject move to the downside like this, right, there are going to be positions that are going to move. There are going to be stocks that are going to move in a bullish direction, or might give us a potential for a bounce off of a support and a move in a bullish direction. So what I'm going to do is I've got a grid here, which is my, let's see, which one is this? This is my sector index grid, right? And this is my sector index grid. So I'm going to bring this up. This just goes through each of the sectors of the S&P 500 relative to their 50-period moving average. Now, this isn't a comparison to SPX, but we could do that. We could look at a comparison to SPX as well. But we're just looking at this in comparison to what its own performance has been. And energy, with crude oil, again, back down a little bit. We see crude oil kind of staying in that range. Energy and the energy sector, not doing so great. In fact, making that move to the downside today to the tune of 2.61%, breaking that 50-period moving average. And I would guess if I had to put a 200-period moving on there, they're probably touching that 200-period moving average. Next one, materials, which is largely tied to energy, to be fair, as well as to the home building industry and manufacturing, making a big move to the downside today as well. So materials getting hit alongside. And again, that seems somewhat counterintuitive to the idea that interest rates are going down. And again, that's part of the resiliency that we've seen in terms of bond yields. And going back to somebody's comment up thread in the chat about, taking out some of the bond vigilantes. But materials as a function of like home building and commercial real estate, manufacturing, those types of things getting hit today pretty hard as well, breaking below kind of a major level of support. Industrials, kind of the same thing, but industrials not getting hit quite as hard. I mean, down 2.82%. We just look at it in a percentage basis, but we look at it in the context of the trend. I think you could still make an argument for a longer term trend still moving, even though it is broken down below that 50-period moving average. We've broken down below a recent low, so it's in an intermediate term downtrend, but not necessarily in a long-term downtrend like some of these others have shifted into. So that's industrials. Consumer discretionary here has a long, long ways to go from breaking the trend line, from even making a new lower low, right? So discretionary is still holding up, down today about 4.74%. So that certainly is a big percentage move. But notice what happened kind of at the bottom of this is we started to see a little bit of a bleed back here. And consumer discretionary, I mean, to be fair, it is still before the holidays. Consumers not necessarily known for reining in their spending ahead of the holidays, even with a change in Fed policy. And so if this does fall, but where would this one fall to? I mean, you got to look from a technical analysis perspective and say, hey, where would we see a break of a major support? And likely maybe down around this 1780 level, or maybe even to make a new low down around the 50-period moving average around that 1716 range, right? Consumer staples, on the other hand, I mean, that trend's still very much intact, even though we've seen the short to intermediate term pulling back. But, we've kind of seen this maybe setting itself up for a double top at this point. It's breaking below the 50-period moving average, to be fair. But it's not a new low. It's not creating a new low at the moment relative to where it has been. That would have to come all the way back down to 857. So maybe some strength here in consumer staples. And you got to remember, again, consumer staples are staples for a reason, because those are the things that we have to buy, right? The need for toilet paper does not abate because of Jerome Powell. Did I just say that's kind of okay. There's some double entendre there for sure, 100%, right? All right, healthcare at this point. And we've been seeing healthcare under pressure, intermediate to long-term trend to the downside, and breaking again, but only getting hit to the tune of about 1.38%. So they kind of left healthcare alone. They took it down in a level consistent with what it has been doing. So likely healthcare not seeing the biggest impact here Healthcare is also at a point where maybe there's the possibility of a bit of a turnaround coming back down into some of these support levels. And I would suspect, again, probably right around that 200 period moving average on the healthcare sector. Take a look at financials. The financials getting the biggest, a big rip here to the tune of about 3% to the downside. In fact, breaking back down into this gap range. Gaps don't always have to get filled. That's mythology. But breaking down below the 20 or the 50 period moving average, you're back into a support level and kind of touching that same range. So again, an area where we might see a little bit of a bounce. Infotech, which is interesting, because remember, infotech has been the big driver of this market for so long and still seems to be that way, right? The fact that infotech back down just right on that 200 or that 50 period moving average. And we've done it once, we've done it twice, 3 times, 4 times, maybe even 5 times back down here since the break back up above. The last time we were down below was back in September, and then it started to rip higher. And we start to see a little bit of a bleed back in. So in terms of what we've seen so far, the one that the segment of the market, the sector of the market that I've seen with the greatest strength still, or the least impact, not necessarily from a percentage basis, right? Not by looking at what the percentage was of damage today, but looking at it from in terms of the overall trend, the one with the least damage, I think so far has been infotech, just kind of looking at this abjectly. Communication services likewise, right? Not down near the 50 period moving average, but maybe breaking below or at to a little bit of a support level here. Still holding that trend. That's consistent with infotech, because comm services have been very, very similar to that. And as we see a shift from just the pure play semis to maybe some of the software companies, that's going to come into play here also in the communication services sector as well. Now, getting hit 3.16% today, certainly not pleasant, but trend-wise, still holding that trend to the upside. This is not a break of the trend, at least not the long-term trend. Short-term, sure. Maybe we have a little bit of a short-term cobra, kind of that little squeeze, that triangle pattern up here at the top that broke, but not changing the trend yet. And I think this is where the benefit of trend analysis comes into play, is not becoming panicky. Utilities, on the other hand, which we would expect would benefit. And again, a lot of utilities kind of falling not only in those small cap spaces, but also moving consistent with the way that the small caps move relative to interest rates, benefiting from lower interest rates, because typically utilities and utility companies borrow for CapEx and bond for infrastructure improvements, things like that. And so interest rates make these companies fairly sensitive to those numbers. And we're starting to see that move to the downside, 2.39%, break below horizontal support level, of course, for the last couple of days, rolling over the 50 period moving average, breaking the 50 period moving average last week, and kind of coming back down into a support level. So some significant impact to the utilities. Then we take a look at real estate as the last of those sectors, and getting hit almost 4%, breaking that support level. This is, in fact, in this particular case, if you want to think about it in terms of a trend change, this is a trend change, right? And if we were to just draw a line, I mean, just to kind of get the difference, right, versus technology, if that were our trend, right, we had a short-term downtrend, we had an intermediate term downtrend, this being the intermediate term downtrend, longer term uptrend. But notice the lows, right? Now we have a new lower low. It's broken that trend. It's broken the intermediate term trend line. 50 period moving average moving to the downside. It's broken out of this channel to the downside. That's a longer term trend change. So real estate kind of in that long-term downward trend. So this is, again, what I suspect is a function of the conversation that Jerome Powell had as opposed to the actions of the Fed, right? And maybe it was the fact that I think, at least in some sense, he was imparting the idea that there wouldn't be more, or there would be a reduced number of interest rates cuts going forward, and the market reacted to that kind of in an adverse way. But if you think about it, and this is what oftentimes will happen when we see a move to the downside created by monetary policy, is the market overreacts, then the market digests what this means, right? The fact that if we have lowered expectation, i.e., more hawkish approach, that generally means that the market, that the economy underpinning all of this is moving a little bit better than suggested. If the Fed had come back and said, look, we got to cut, and we got to cut, and we got to cut, and we got to cut, we might have had an initial move to the upside because the markets react to that and say, oh, cool, easing. On the other hand, then that suggests that the underpinnings of the economy maybe are a little bit more shaky as opposed to where they are at this particular point. So I think that kind of suggests that maybe this is an initial overreaction. So we think about what might benefit from this overreaction initially, and that comes back into infotech and comm services kind of setting themselves up for that possibility of a bounce off of some of those support levels, or off of the 50-period moving average, which could be acting as a support level. Speaking of support, help us out. Support these webcasts by clicking on that feedback survey and helping us out. So now that we kind of have that sense of what has been going on, let's kind of take this to the next step here, and let's kind of put this into a little bit more of a discussion, right? So now if we have that sector strength coming in back in infotech and, whoops, let me kill that annotation real quick because it was sitting there. In infotech and comm services, looking for potentially this bounce to the upside. Then, what we might do is we might look for where there's some areas of strength, because something was getting bought up off of the bottom here at the end of the day. So if we go to the Market Watch tab and we go to our Visualize tab and we go to there's going to be a sea of red here for sure, 100%, as there is in a sell-off like this. And we see bright red, big bright red. Let's go down here to information technology and see where we see a little bit of, maybe there's a little bit of good news here down in electronics. And J-Bill Circuit making a big move to the upside here today. So some possibility of that being some strength. But remember, and Cameron's talked a lot about this particular tool in a number of cases. This is a one-day snapshot, so this is going to be reflective of kind of that overreaction. What maybe is a little bit more important is what happens in the next few days on this particular tool and other tools, right? So I'll tell you what I want to do is I want to kind of do two things. I want to kind of give us some searching capabilities here that maybe benefit from dividends as well as this potential for growth. So if we've established that infotech is probably the area from a trend standpoint that has the most potential for growth, and also probably the highest beta in terms of movement versus the S&P 500 generally. If we go to the scan tab, I've got a couple of different scans built here. One is one that I built a couple of days ago in an event that I did for our branch networks on dividend growth investing. So looking for stocks that have the potential to grow and potential for increasing their dividends. But I wanted to kind of build this again a little bit here. I wanted to do, so I've got this kind of saved, so I want to come back to this. So what I want to do first is I want to reset my scan here on the scan tab. I want to do a couple of things. I want to build a scan here that's just kind of a general overall scan. I want to look at net change being positive, right? So I'm going to take out volume. I'm going to take out percentage net change. I'm not worried about that. I just want positive net change. I want something that's been moving up, right, generally. And so I'm going to look for positive net change, something coming up off of the bottom, and there's not a lot. And what I want to do, if I were to just run the scan, I'm going to get about 50, maybe a little bit more than that. That's just kind of looking through everything that saw positive net change. But now what I want to do is I want to filter this a little bit more. So here's what I want to do. I want to scan in, okay? I want to scan in a particular group. So I want to scan in stocks that generally have been increasing their dividends. So I'm going to go to this one. I'm going to go to the 25 plus year dividend increase, and I'm going to scan in that particular group. Now, that's what Michael Fairborn typically will refer to when he talks about dividend aristocrats. 50 years, typically those dividend kings. So we're going to look at those that fall within that 25-year dividend, and I've got two of those. And if I run the scan, I've got two, Cardinal Health and Church and Dwight, that fall into that particular characteristic, right? So that might be a little bit limiting, right? So that might be just a little bit limiting, because if I were to do an intersection with the information technology sector and I run that scan, none of those come out of that scan, right? So that becomes a little bit of a problem, right? Because now I don't have anything that's got dividend growth that is considered to be a dividend aristocrat. So what I kind of have to do is I want to look for dividend growth as a function. Now, remember, when we put on these scans, some of these scan tools won't work if you are in a if you're in the paperMoney account. So you have to do some of these scans in a live account. But I'm going to shift my my kind of Venn diagram that I'm establishing here to the S&P 500 and the information technology group and positive net change. And then we're going to add into this mix. There's Jabil and there's Motorola, which also saw positive movement, right? So looking at those two particular stocks that saw that positive movement, right? Now, trade them in paperMoney only, but sometimes you can run these scans that way. So here's what I want to do, and maybe we were being too limiting in terms of this positive movement. Let's go back and let's do this again. Let's go to scan in S&P 500, and let's change that. Let's scan in our dividend aristocrats intersecting with information technology, and let's see if we've got any in there. IBM and Roper Technologies, okay? So these are companies that are in that stronger industry or stronger sector, information technology, that fall in that 25 plus year dividend increase range. And if we take out the filter of what happened today, now we've got two companies that kind of fall within that category. So I'm going to go to IBM. Let's go back over here to the chart. I'm going to pop this back to my single grid. We'll take a look at IBM in this single grid, IBM. We'll say, all right, what's going on with IBM? It's made this move to the upside. It's now started to pull back, still making a higher high, and still kind of sitting there. What about Roper, R-O-P? And this is one that probably has a little bit weaker trend than IBM. So maybe not quite the performance that we're looking for, but at the same time, if we think about this, IBM, let's come back to IBM, and let's look at this particular stock. RSI is still positive, right? Even though it's been pulling back. Trend's still positive, even though it's pulled back a little bit below this high here. We still had a higher high. And I was using this as an example earlier this week or last weekend in the workshop that we did in Houston. By the way, Ricebird was there, and William W. and a few others. We talked about IBM. Looking at this as a potential bounce. So the possibility is there for getting into a trade if we get some sort of bounce and some sort of evidence that is moving to the upside, simply from the standpoint of saying, hey, you know what? This is giving us kind of that confluence of dividend and value, or dividend and potential for growth, right? But that's kind of a big what if, right? We might need to see a positive movement here, or a move to the upside, maybe a break above that resistance level at the 229 mark, and that might be okay, right? In terms of getting into the trade. But I think we can maybe do a little bit better in terms of our scan. So what I'm going to do in this scan is I'm going to come back over here, And I'm going to reload that dividend growth scan that I had built before. And let me just show you what we've got in here. We're looking for large cap stocks, generally, looking for stocks that have positive beta, but not too high a beta. Looking for a mark price better than $30 a share. So no penny stocks, kind of filtering those out. And we're looking for stocks that have generally been increasing their dividend payout over time and have a dividend that is, or a dividend yield that's between 2% and 8%. So about half of that dividend yield, about half of the annual performance expectation in terms of stock price appreciation of the S&P 500, right? And then by default, as I put this study in here, I've got a moving average scan. So I'm looking for a stock or stocks whose closing price is at least 5% above the 50-period moving average, right? That might be a little bit too aggressive given what's happened today. So what we might do is we might bump that down to 2% above the 50-period moving average. And we're still going to keep that in this S&P 500 group. And we're just going to run the scan and see what we get. We get CME, CNP, Honeywell, and Kroger that meet those characteristics, right? That meet those characteristics. Now, we know that some of these are in the energy sector. Kroger is in the consumer staples sector. Honeywell is kind of falls into the kind of halfway between industrials and technology. So I'm interested to see what Honeywell is doing here in this particular case. So let's go to the charts and let's take a look at Honeywell, HON. And Honeywell is kind of at that point where we're maybe seeing a little bit of a bounce up off of this support. RSI is kind of staying at equal lows. So not a lot of just abject sell-off here, even though it was a downward day, right? So this is one where I might say, look, I want to see some positive movement here. I want to see an upward move and maybe even above the high of this low day, right? A hold, close above the high of the low day in terms of getting into this trade to see that trend continue. Now, to be fair, that's going to sacrifice a fair amount of move off of the bottom side here. So what I might even do is say, hey, let's cut that candle in half. Let's say if this moves above that 230 mark, then enter the position, looking for that to be evidence that this price is going higher, but put in a stop that is a little bit lower here that gives us some freedom to move. So what I'm going to do is I'm going to right click and I'm going to buy custom with stop in this particular case. And again, remember, this is not a recommendation. This is simply an illustrative example. So I'm going to change this order, that 230 order, kind of the midpoint of that candle. I'm going to change that to a buy stop. Now remember, stop orders, whether it's a buy stop, sell stop, doesn't matter. Only allow us to specify the activation price and not the execution price. So I'm going to make that a buy stop. We'll make that good till canceled. And I want to get in if price goes above the midpoint of that candle. That can often be a resistance level, especially on the way back up in a bounce. So if it doesn't break above that, doesn't break out of that short-term ascending triangle, I don't want to get into the trade. Now I'm going to say, look, I've got a support level right here at about 223. I want to come below that 223 level a little bit and maybe down here below that support into that gap. So maybe right around the 219 mark, I'm going to give it a fairly wide stop because I want to be willing to take the movement in this trend. So we're going to make that a 219, and I'm going to make that kind of a weird number. We'll make that 219.27, and I'm going to make that a stop. And again, stops don't guarantee at what price that's going to get filled, just the activation price. So I'm going to put that in there as good till cancel. We're going to keep that stop in place. So we're going to look at getting in somewhere right around here if it comes out, if we get into the trade and then it gets out. So we're going to go ahead, click on confirm and send. I'm going to put this in my stocks group so that we can come back to that and find it after the fact and click on send. And now we've created that order to get out of the trade. Now you could make it an extended time frame on that good till canceled, and that may potentially give you the opportunity to get into that trade in those extended time frames. But we're looking at putting this position on. So running that scan, this is also something that we can play around with. If that 50 period moving average is a little bit too restrictive, we might go down to the 100 period moving average and say 2% up off of the 100 period moving average and run that scan. And now that gives us a lot more candidates. Because that gives us a lot more candidates, we might intersect that then with our industry strength and go back to our information technology and run that scan again, and we get Cisco systems that meets that characteristic. Let's go to the chart really quickly for Cisco, CSCO. And again, here's another one. Technology, it's pulling back, but it's not breaking necessarily the trend at this particular point. And so once again, this might be one that we could enter on a bounce. But the RSI kind of breaking down below that level there suggests to me that maybe there's a little bit of weakness. So maybe we look for this to come back up above and have the RSI turning around. So this one might be one that we would say buy stop above 58.68. So I'm going to buy custom with a stop, and we'll just do this really fast. Buy custom with a stop, and we'll make that a move above that 58.70. I'm going to make that 58.70. Again, no guarantees because this is going to be a buy stop. To get into the trade, we'll make that good till canceled. That's going to be evidence that the price is moving higher. And then we'll put that stop somewhere below this level here, maybe the 56.25, a little bit below that support. We'll make it 56.11. I like that, 56.11. Again, remember, market makers know that people like to put stops at big, round, even numbers. So make those stops maybe at one thing to consider might be putting those stops at kind of weird numbers. 56.11 is kind of a weird number. It's not a round number at all, right? So we're going to put that in place, and then we're going to click on confirm and send, read through the order, make sure that we're aware of the fact that those stops don't guarantee the execution price, just the activation price. We'll send this to our stocks group as well and click on send. And now we've got stocks that generate dividends, that have dividend growth, that are moving in an uptrend. And if we get into the trade, there is that potential for that move to the upside, seeing confirmation of that. But until that happens, we're not getting into the trade. So we're making this a conditional based on the stock giving us evidence. So it's if this, then that. If price moves higher, then enter the trade, right? So now, if you were to put that stop in as good till canceled in the extended hours, then there is a potential for that order to fill during that time frame. But the thing to remember, even still, even as popular as extended hour trading is starting to become, and we're now getting to the point where very soon we'll be able to trade the symbols in the S&P 500 24/5, there's still less liquidity in that time frame just because people sometimes have to sleep. And so stops sometimes can get hit in those timeframes when they maybe wouldn't otherwise. So that is something to be concerned with. So what we've done, and I'll do this. Let me do this for you as well. Let's go back to that scan tab. I'm going to come over here. I'm going to go share scan query. I'm going to click on share, and I'm going to put this out into the chat for you. Now remember, shared items, including scripts and scans, are not guaranteed as to time or accuracy. So do with it what you will. Remember that likely has to be done because we've got a study scan in there, or a study filter in there. Will likely have to be done in a live account, not a paperMoney account. So be aware of that as well. But I'll also put that in the description for those of you that are watching this in the recorded version. But guys, thanks very much for this discussion, and help me and talk through the idea of trading growth and value stocks, and look at what's going on in the market and what's happened today. Sometimes it's good to just talk through and see what has gone on, kind of put it into perspective. But my thanks to Cameron May for helping out today. We've got the feedback survey out there. Thanks for posting that again, Cameron. Fill out that feedback survey. Thanks to our great production staff, and thanks to all of you for joining us today for this webcast as well. We will see you again very soon. Take care, everybody. Bye-bye.